All right, our next presenter is Paula Star. Paula is from the UCEDC, and Paula is going to come up and discuss a topic which I assume many of you are interested, and that's kind of where to find financing and non-traditional routes of, kind of where to go when the bank says no type of thing. So Paula, come on up.
Hi, can you all hear me?
Yes.
Good, okay. And please let me know if you can't along the way, because I promised Chris last week that I'd get over my cold before today, but I don't think that's happening. So if I get a little bit verklempt, it's not because of anybody here, but just because I am still fighting this cold. We did our 2-minute presentations. Some of the folks at the table, it'll be a little bit of a repeat for them. But how I came to UCEDC, which I'll explain in a minute, which is a lot of initials. I am a former commercial banker, in some cases. I'm also a former business owner, yay. And one of the things that I did not know when I bought a business was that there was non-traditional financing. My financing came from what I like to call the bank of husband. Had I known that there was a place to go for small loans for small businesses or for bigger loans for bigger businesses, that would have been great, but I didn't. A lot of the folks that I work with at UCEDC have that same type of background. So we have our skills. Mine is in lending, obviously. We also do training and technical assistance and help to business owners to maintain and grow their businesses. And I know you guys are all about help, or you wouldn't be on your alternative boards. So helping small business is a very big component of what we do. I came to TAB and I met Chris actually through an alternative board member that we just got approved for one of our SBA program loans. And we should be sending him out his commitment letter today and hopefully be closing on a loan to the company very shortly. So that's the kind of success story we like to have. So what is UCEDC? We used to be Union County Economic Development Corporation back in 1977 when we started, and we evolved over the years from just a straight EDC helping to bring business into Union County into our first loan program, which was microlending, which we started in about 1991. Microloans are just what they sound like. They're not $500 loans to ladies in Africa to make beaded necklaces, but they are loans of up to $50,000 for anything from literally a startup company that has not opened its doors yet to a company of maybe a year, 18 months, 2 years, 3 years, all of those types of companies that are not yet bankable because most banks won't make a loan to a company that's less than 3 years old. That may not be the issue with a lot of you folks here, but then we have 2 other programs that also are a bit of alternative financing and also may be applicable to companies that are a little bit larger. All of our programs, though, are based on the SBA's definition of a small business. So what's a small business? It's not so small. Basically, in order to qualify as a small business with the SBA, you have to have a net worth of less than $15 million. So right away, that's not all that small. You also cannot have had net profits of more than and that's net profit after tax, of more than $5 million for the 2 years prior to having applied for an SBA facility. So that's not exactly a small business. For most retail businesses, and there are a lot of exclusions to that as well, but for most retail businesses, the rule of thumb is that you should have sales of no more than $7 million. On the other hand, however, and that includes sales of any affiliates or subsidiaries, there are, however, probably about 100 exclusions to that retail law. So for example, gas stations are one, and we're working with the gas station, as a matter of fact, that has an aggregate of about $20 million in sales when you include all the affiliates. But on the other hand, gas stations typically don't have small amounts of sales, so the SBA considers the sales of the gas station, for example, to be the spread that they make on each gallon of gas, which can considerably lower your sales. So there's a lot of exceptions to that $7 million rule. And then for most wholesale businesses, you cannot have more than 100 employees. Again, not so small. And for manufacturers, you cannot have more than 500 employees. So I don't know, is there anyone in this room that has more than 100, more than 500 employees? So these programs apply to lots of folks. So as I said, our first program is microloans. Most of you in the room may have a business that's a little bit more mature than a microloan, but on the other hand, it's not necessarily for startup or brand new businesses. It's also sometimes for businesses that just don't need a lot of money at the present. So as I said, basically our loans go, depending on the life cycle of your business, go up to $50,000. And if some of you have been to a bank looking for $20 or $30 or $50,000 for a piece of equipment or anything like that, you may have found that a lot of times today the bank just doesn't want to bother. It's nothing personal, it's nothing necessarily to do with your credit, but the fact of the matter is, in today's credit cycle, nobody's just signing off. I mean, I remember when I was in commercial banking, you know, somebody wanted $50,000, $100,000, you got a good credit score, that's it, sign on the dotted line, you got it, secured, unsecured. Banks don't do that anymore. They analyze everything. And the thing is, it's really what's more cost effective. Did they spend hours and hours analyzing a $50,000 or $100,000 loan or a $30,000 loan? Or did they spend those same hours and hours analyzing a $3 million loan? It's pretty simple. They're going to want to go for the bigger loans. And most of our bankers, who we get a lot of referrals from, have flat out told us that they don't want to do ideally less than $350,000 in financing, and typically they don't want to do less than $250,000 in financing. Which brings us to our second program, which is the SBA 7(a) Community Advantage Loan. And that's actually what we're working with one of the alternative board companies here. What's the Community Advantage Loan? The SBA calls it a loan for underserved borrowers. Now that doesn't mean that you have to be, you know, working in a slum neighborhood, or that you have to be disadvantaged yourself, or, you know, even that you have to be a minority or anything else. Underserved companies basically means just that, companies that can't get back lending again. For what reason? Well, you might be, as one of our clients is, in business only 14 months at the time we made her $150,000 loan, but was going gangbusters with her business, was making a lot of profit, needed some interim working capital to be able to take on some more contracts from people that were literally banging down her doors. But hey, guess what? After 14 months, you could be making $5 million a year, and the bank will not look at you because you don't have 2 years of statements or 3 years of statements. A lot of banks won't do franchises. That's something that we work with as well. The other really neat thing about this loan that, you know, I just absolutely love, because it's a great loan for younger companies or companies that don't deal with heavy-duty assets, is it's a cash flow-based loan, which means if you don't have 100% collateral for the amount of the loan you want, that's not a reason to decline. So don't, on the flip side, however, whatever you do have, the SBA will want to take, including, you know, liens on personal residence, all your business assets. But if they have to take a second lien or a third lien, or again, if you don't have 100% collateral to, you know, to cover the amount of the loan, but you've got good cash flow, that's not a reason to decline. So again, for companies that, you know, haven't been in business all that long, for companies that are service oriented, for companies that have, you know, receivables more than heavy assets, that's a great loan program. Either the microloan or the Community Advantage Loan, however, can be used, and that's another great thing, for almost anything that is legal. Now, we don't do, I have to stress that we've had some interesting requests. So you can use the money for soft costs. You can use the money to build a website. You can use the money to print your business cards. That's particularly important for some of our younger companies or startup companies. You can use the company to hire staff. That's a big part of what we do, especially with the Community Advantage Loan. So, you know, you've got to this point, you know you can take on more business, but you need an account officer to service that business, or you need a salesperson to go out and get the business that you know you can attract, and you've got good cash flow already, so you can start paying this loan back. But how do you go to that next step? It's a chicken or egg thing. If you don't have the money to start paying somebody, how can they service the accounts that come walking in the door? If you don't have the money to produce a product, how can you service a contract that, is out there for the taking if you just have the money to produce the product? So, and again, that's where the cash flow based nature of this is terrific, and that's where, again, a bank will not typically lend you. They'll give you a working capital line, but they usually have to see receivables that are already higher than the line that they're giving you, or you have to have the staff on board. This loan really gives you the ability to go out and get additional business. These loans are really all about expansion. It's what can these loans do for you? What can the SBA do for you to help the business continue to grow? So again, on the flip side, none of these loans are to fund operating losses. None of these loans are to get you out of the hole. Most of what we like to see are people who are planning in advance for what they're doing, and the business plan is very important to us. But they are loans that are meant for expansion. Then we have a third program, which we actually are very proud of, that we just got approved for, just to extend the alphabet soup. So we're UCEDC. We're Certified Development Financial Institution, CDFI, which gives us the ability to make the SBA microloans and community advantage loans. And we're also now what's called a CDC, a Community Development Corporation. What do CDCs do? CDCs participate in what's called the 504 real estate program. And that really just totally breaks the ceiling as far as how big your company can be to take advantage of this, because you can get over $11 million in financing with this program for expansion of real estate, manufacturing equipment, fixed assets. It's not so much a working capital loan, but it is definitely, nowadays, if you're renting, sometimes you can increase your space and own the property for the same amount as what you're paying in rent, and that's what this program is for. So what we do is we partner with the bank, and how we get the bank could be any way. You could bring your bank to us, we might go out and source a bank may bring their client to us. It's a three-part loan. Oh, and another thing I should mention, again, with all of these loans, microloans, 7A or 504, borrower's equity, 10%. You never have to come up with more than 10% of your project costs. So if you're buying real estate, that's particularly important, because if any of you have gone to a bank to buy real estate, even if it's a home in the last couple of years, what do they want you to come up with? 20%, 25%, 30%, maybe the market will go down again. So that's a very, very significant factor. Your equity contribution only has to be 10%. And if you already own a building and you want to expand it, put an addition on or something like that, there are formulas that can help you use the equity that's already in your building if you've had it for 10 or 15 years and you've built up equity to the point where your actual contribution might even be less than 10%. So you put the 10% in, bank finances 50%, and they typically sign on to give you a 10-year fixed rate at standard rates, which today are probably like 5.5%. The remaining 40% is funded by the CDC, by us, in the form of a bond issue. Now, it's not like the EDA bond issues where it costs you like $50,000 for bond counsel and you float your own bond and all of this. The portion that we finance goes into, and I hate to say a bond pool because it sounds like a loan pool and it sounds like everything bad that happened 4 years ago, but it is a bond pool. It's a SBA guaranteed bond. Your share of the loan goes into that bond pool, and with that we have the ability to give you a 25-year below market fixed rate on 40% of your loan. So right now that rate with servicing, now there are some fees involved here, but they're typically rolled into the loan. So with servicing fees, with spread on over the T-bill rate that it's keyed off of, you're probably, if you were to close a loan today, you would get somewhere between 404 and 415 on 40% of your loan amount fixed for 25 years. We take a second position. The bank takes the first position. So, they're lending only 50% on whatever the value is of the property. We lend you 40%, you come up with 10%. And again, these loans, while not necessarily for working capital, they are for purchase of fixed assets, manufacturing equipment, expansion of a facility, renovation, including redoing your parking lot, etc. There is a jobs component to this, so you do have to sort of sign on that the expansion will create jobs, because then, again, remember, all of these programs are all about, helping to expand business, helping create jobs, etc. The job component, though, only applies to our share of the loan. So the theoretical job component is for a non-manufacturer, one job for every $65,000 that we lend to you, not the whole loan, just of the 40% that we lend to you. If you are a manufacturer, that's one job per 100,000 that we lend to you, and they give you theoretically about 2 years to put those jobs in place. Now, we're not the job police. We like to see what your projection is. We will look at whether there is a job creation component in your projection. So if you're telling us that you're going to create 10 jobs with this property, and you give us projections and your payroll's not increasing, we may kind of question where these jobs are going to come from. But basically, we go with your projections for that job creation. Nobody's going to come out a year from now or 2 years from now and say, oh, you only created 7 jobs. You can't have your loan anymore. If anything, they will look to us to see that we're filtering the right kind of companies and working with the kind of companies that truly are expanding. So the job component, while it's there, is nothing to be terribly fearful of. And the government certainly also understands after the past several years that things can change and sometimes your projections don't work out. But the project has to be legitimately for expansion. That's really the main point. It's, again, for growth of your business. So it's not really, they had a refinance program for about a year, but that ended last month. So it's not really to refinance old debt. It's not really, again, to get out of other debts. It's not to dig yourself out of a hole, but it is for expansion of property, or it is to acquire property and thereby be able to grow your company, because maybe you're now paying less for that loan than you were paying in rent, so maybe you can hire somebody else now. So that's the point. To get started with any of these, pretty much the same as what you would do for a bank. We love business plans. Probably most of the folks in here know how to do a business plan. If you don't, we have classes on how to do a business plan, but as I said, I'm sure that most of you have done them. If you've done them and they're sitting on your shelf, then you dust them off, redo them, not just for us, but for yourself, because a business plan should be a living, breathing thing that helps you assess if you're going where you want to go with your company. We usually start by looking at the business plan, looking at your projections, seeing if we like your concept, seeing if your ideas make sense. If that's the case, then we go through the standard package of 3 years financials and personal financials and receivables, payables, et cetera, just like a lot of you are probably used to with banks. So it's a pretty standard process. It takes generally, I would say, about 60 days to get a community advantage loan. It takes probably 90 to 120 days to get a 504 real estate loan approved. Oh, and by the way, on your 504 real estate loan, once it's approved, if your project is a construction project, if you're building a new building or adding to a building, the deal is the bank gives you an interim loan to do that construction. So you're never really waiting for the whole thing to close. So you get your interim loan, you do your construction, and then we take out 40%. We pay the bank back for that share. So that's it. That's where we are. We're committed to helping small business. We've been here for, over, 30-something years helping small businesses, medium-sized businesses, and that's what we love to do. So, thank you. Any questions? Wow. Okay, questions. We work throughout the state of New Jersey. Our office is in Cranford, but as I said, we haven't been Union County based since like 1992, so we will go anywhere in the state of New Jersey.
Any other questions?
Thank you.
That was great. A lot of information there. Again, if there was anything you wanted to hear, you had a question on it, the video will be posted at christalks.biz. let's take a quick break. I think somebody took my agenda. What are we, on a break till 10:25? And 10:30, and then we're gonna switch tables, so make sure you have your table assignments, okay? Take a break.